The sheer scale of global indebtedness in the 21st century is a phenomenon that warrants careful scrutiny. The United States, as of the latest figures, carries a staggering $31.5 trillion in public debt held solely by the federal government. This colossal sum, however, represents only a fraction of the total debt burden. When we factor in the roughly $3.2 trillion in state-level debt, the $17.1 trillion owed by American households, and the substantial $24 trillion in corporate liabilities, the domestic debt landscape of the world's largest economy becomes even more daunting. Yet, the United States, despite its position as the most indebted nation, accounts for only a segment of the global debt edifice. The cumulative global debt now surpasses an astonishing $300 trillion. This figure encompasses a vast spectrum of financial obligations, ranging from the trillions held in U.S. government securities to the modest balances on individual credit cards. Every borrowed dollar, pound, euro, or yen, irrespective of its purpose, whether funding national infrastructure projects or facilitating the purchase of consumer goods, contributes to this immense total. Averaging out this global debt figure reveals a stark reality. It now stands at nearly 3 times the global gross domestic product, GDP. On an individual level, the average person alive today carries a debt burden of approximately $40,000. This is particularly concerning when juxtaposed with the average global per capita output, which hovers just above $10,000 annually. Economists and financial commentators offer a wide array of perspectives on this situation. Their opinions span the spectrum from outright dismissal of any significant risk to dire predictions of a global economic collapse. As is often the case with complex macroeconomic issues, the truth likely resides somewhere between these two extremes. Most prudent economists express concern about the current debt levels, acknowledging that while the situation might be sustainable under certain conditions, it introduces significant vulnerabilities into the global financial system. For individuals navigating this complex environment, a fundamental understanding of debt, its functions, and its distinct behavior at individual, national, and global levels is crucial. Therefore, several key questions arise. To whom is this vast sum of money owed? Can a debt load equivalent to 3 times the global GDP ever be considered sustainable? Are there responsible strategies for reducing this debt burden? And perhaps most importantly, what are the potential catastrophic consequences if we fail to manage this debt effectively? Deconstructing global debt on a global scale operates under a different set of dynamics compared to individual debt. When an individual takes out a loan, there is a clear external entity, a bank, a credit union, or another individual, that provides the funds and to whom repayment is owed. However, at the global level, there is no such external lender. Economists often humorously point to the absence of Martian banks willing to approve our loan applications to illustrate this unique characteristic. This inherent peculiarity of global debt can make it challenging to fully grasp. However, understanding this distinction is paramount. When considering global debt, it's not so much about borrowing from an external source as it is about the global economy owing money to itself. Every liability held by a government, corporation, bank, or individual simultaneously represents an asset for another entity within the global economic system. To illustrate this, imagine a simplified global balance sheet. If the total outstanding loan representing global debt stands at $300 trillion, an increase in this balance occurs when the global economy collectively spends more than it repays. While such behavior might be deemed irresponsible at an individual level, at the global level, every dollar added to this liability side of the balance sheet corresponds to an equal dollar added to an asset on the other side. Taking on more debt, therefore, is not inherently negative. In fact, it can be a powerful catalyst for economic growth if the borrowed funds are strategically deployed to invest in projects that enhance the long-term productive capacity of the global economy. When economists analyze debt at an economy-wide level, they often relate it to GDP, resulting in the widely used debt-to-GDP ratio. While a valuable metric for economists, this ratio can be easily misinterpreted and made to sound more alarming than the underlying reality. The fact that total global debt is 3 times total global GDP needs to be contextualized. Debt is a cumulative stock accumulating over time, whereas GDP is a flow, a discrete measurement of economic output within a specific year. For an individual, a debt 3 times their annual income might not be excessively concerning if it comprises long-term, value-generating assets like student loans or a mortgage. A potentially more insightful measure is the comparison of global debt to global assets, akin to calculating a global net worth. While economists don't frequently employ this figure due to the complexities of accurately valuing all global assets, it offers a different perspective. In 2021, total global assets, encompassing everything from real estate and vehicles to stocks, cryptocurrencies, and the bonds and loans that constitute global debt, were estimated to be around $1 quadrillion. Subtracting the record global debt of $300 trillion yields a global net worth of approximately $700 trillion, suggesting that overall, the global economy's financial position is stronger than ever before. The significance of GDP economists primarily focus on GDP figures due to the inherent difficulties in accurately assessing global asset values. A family heirloom, for instance, might hold vastly different subjective values for different individuals. Determining a standardized global valuation for such diverse and often illiquid assets is a monumental challenge. Consequently, the $1 quadrillion figure likely underrepresents the true value of smaller, less liquid assets. Beyond the practical challenges of asset valuation, GDP figures provide economists with the essential information they need to analyze economic trends and formulate policy recommendations. GDP, in its simplest form, represents the total output of an economy. Theoretically, this could be calculated by summing the value of every good and service produced for the market within a given year. However, the logistical nightmare of tracking every single production line, restaurant transaction, and service rendered makes this approach infeasible. Instead, economists typically analyze spending patterns, operating on the principle that every good or service produced for the market will eventually be purchased in some form. This approach is akin to a photographer working with negatives. The data collected is the inverse of the desired image, but it allows for the construction of a detailed representation of economic activity. GDP is equivalent to total output, which, in turn, equals total market demand. This demand can be broken down into 4 key components: consumption, investment, government spending, and net exports. When analyzing the total global economy, net exports can be considered zero, as there is no external entity with whom Earth currently engages in trade. An important nuance is the treatment of unsold goods. If a business produces goods that are not immediately purchased by consumers, these goods are either classified as investment, if stored as inventory for future sale, or somewhat counterintuitively, as consumption, if discarded. Macroeconomists compiling GDP figures focus on the act of production, regardless of the ultimate fate of the goods. The role of debt in economic cycles. Increasing debt, all else being equal, tends to stimulate economic output by injecting more purchasing power into the economy. When governments increase their debt, it is typically to finance welfare programs or infrastructure projects without resorting to immediate tax increases. Households take on debt to finance consumption or to make investments in assets like housing. Businesses borrow to acquire machinery, or in more recent times, to repurchase their own shares, which is also classified as a form of investment. Governments, businesses, and households collectively account for the vast majority of global debt. Some economists also include a separate category for financial corporations, as their borrowing activities are often geared towards creating more debt instruments rather than for their own direct consumption or investment. Regardless of its specific use, the initial effect of taking on debt is an increase in one or more of the components of GDP. However, this debt subsequently requires repayment, which necessitates reduced spending by households, businesses, and governments. At an individual level, the cycle of borrowing and repaying debt occurs in distinct peaks and troughs. However, the global economy, comprising billions of individuals, millions of businesses, and hundreds of governments, experiences a smoothing effect due to the law of large numbers. Nevertheless, the underlying cyclical pattern persists. The propensity to take on debt is closely linked to confidence in future economic prospects. During periods of high employment and favorable global conditions, individuals and businesses are more inclined to borrow, fueling consumer spending and investment. Conversely, when debt levels become elevated and the focus shifts towards repayment, consumption, and investment tend to decline, leading to reduced economic output. Scaled up to the global level, this illustrates how global debt essentially represents a borrowing from future economic activity. This phenomenon is what economists refer to as the debt cycle. It explains why, even in the absence of external shocks, economies tend to experience natural booms and busts roughly every decade. Governments play a crucial role in mitigating the extremes of this cycle through counter-cyclical fiscal policy. During periods of high private sector borrowing and spending, governments should ideally increase taxation and reduce spending to build reserves and prevent overheating. Conversely, during economic downturns when debt repayment is prioritized, governments should reduce taxes and increase spending to prevent a complete economic stall. While governments are generally adept at stimulating the economy during downturns, whether triggered by debt cycles or external shocks, as seen after the global financial crisis or during the recent pandemic, they often struggle with the less politically palatable task of raising taxes and cutting spending during economic booms. This has resulted in a consistent trend over recent decades of governments worldwide accumulating increasing levels of debt, often mirroring or even exceeding the borrowing rates of businesses and individuals. The double-edged sword of government debt. However, government debt is not inherently detrimental. If the borrowed funds are strategically invested to expand a country's productive capacity and generate more value than the debt incurred, then it can be a positive force. Such investments lead to increased global wealth, leaving a more prosperous future for subsequent generations. The most direct way for governments to achieve this is through investments in infrastructure and education, thereby enhancing national productivity. While some government spending is necessarily directed towards purely humanitarian endeavors, a significant portion is allocated to projects like transportation networks and public utilities. These projects, while serving the public good, often do not generate direct financial profits. Nevertheless, most advanced economies employ economists to conduct rigorous cost-benefit analyses on major projects to ensure that their expected economic benefits over their lifespan outweigh their costs. For instance, a more efficient rail line can reduce transportation costs for businesses and improve labor mobility, leading to increased productivity and, consequently, higher tax revenues, which can then fund further beneficial projects. Interestingly, similar analytical frameworks are even applied to seemingly non-economic areas like defense and social programs. A nation with secure trade routes, protected borders, lower crime rates, and opportunities for disadvantaged populations is likely to experience higher overall economic output and generate more tax revenue. The danger arises when governments accumulate debt to fund projects that fail to generate a positive economic return. Such unsustainable spending can ultimately lead to fiscal crises. The substantial stimulus measures implemented by many governments during the pandemic, while crucial for averting immediate economic collapse, are unlikely to yield significant long-term positive effects on economic output. These policies were primarily focused on short-term stabilization rather than fostering long-term growth. The composition of debt and global net worth. The composition of economic activity, particularly the balance between consumption and investment, is arguably even more critical for households and businesses. Consider a simplified economic output, a plate of pasta for immediate consumption versus a pot that can be used to produce more pasta in the future. Both have value, but the pot, as a capital asset, retains its value and contributes to the roughly $1 quadrillion in global assets. The consumed pasta, on the other hand, ceases to provide future economic value. Therefore, debt incurred to acquire assets is generally considered good debt, while debt used for immediate consumption is often labeled bad debt, as it does not generate future economic value to facilitate repayment. Encouragingly, a significant portion of global debt is used to finance investment purchases. This means that current production contributes to the growth of the global asset base, ultimately leading to greater overall wealth. All else being equal, a global economy with $1 quadrillion in capital assets and $300 trillion in debt is in a stronger position than one with only $700 trillion in capital and no debt, as the additional capital can drive job creation, foster new industries, advance technologies, and generally fuel long-term economic growth. However, this positive outcome hinges on ensuring that investments are directed towards assets that enhance future output. Global net worth as a proportion of GDP has increased by approximately 50% in the last 50 years and 25% in the past 2 decades alone. During the same period, nominal GDP has increased more than tenfold since 1970. While this might initially seem positive, it suggests that the investments made into the world's $1 quadrillion worth of assets are, on average, less productive than they were 50 years ago. This is particularly evident in advanced economies, where wealth has grown significantly faster than output. Thus, while debt is increasing, the true productivity of the underlying assets is not keeping pace, at least on paper. The value of any asset is ultimately determined by the forces of supply and demand. The accumulated value on the global balance sheet is contingent on the willingness of buyers to pay those prices. This introduces a significant risk associated with higher debt levels. During economic downturns, the market value of assets can decline much more rapidly than the face value of debt, which only truly diminishes if it is forgiven or if the borrower defaults. A useful way to conceptualize global debt is through the lens of the risks it presents. It can amplify economic booms by facilitating more rapid expansion and enabling projects that would otherwise be infeasible. However, it can also exacerbate economic downturns as debt holders demand repayment regardless of prevailing economic conditions. While today's debt load is high relative to current output, it is lower than historical peaks when compared to the planet's total wealth. This is positive, provided that this wealth is actively contributing to increased output and opportunities. Unfortunately, a significant portion of the asset appreciation in recent decades has been concentrated in non-productive assets, primarily real estate. The total value of global real estate is estimated at around $350 trillion, with approximately $250 trillion representing land value alone, equivalent to 2.5 times global GDP. The remaining $100 trillion comprises the physical buildings. When an economy invests heavily in research and development of new technologies that enhance production efficiency, these investments tend to generate greater long-term output, allowing for further reinvestment and increased consumption. Conversely, investment in land does not fundamentally alter its productive capacity, it merely increases its price. Higher land prices, in turn, increase the cost of one of the key factors of production, land, labor, and capital, putting downward pressure on overall output. Furthermore, excessive investment in real estate can crowd out investment in potentially more productive ventures. Many rapidly developing countries are currently facing significant debt challenges as their growth has stalled, making financing increasingly difficult and expensive. While channeling debt towards real estate in advanced economies might be perceived as safer than investing in factories in developing economies, even if those factories could generate greater global output, it is still suboptimal for global debt to primarily fuel speculation in unproductive assets. The ownership of global debt. Zooming in from the global level to a national perspective highlights the crucial question of who holds this vast amount of debt. Approximately 95% of global wealth, or net worth, including the $300 trillion in outstanding debt, is owned by households. Governments control the remaining 5%. Businesses, while the primary drivers of value creation, own assets, but the companies themselves are ultimately owned by individuals, either directly through share ownership or indirectly through retirement savings plans. The 5% of global net worth held by governments comprises foreign currency reserves, public real estate, state-owned enterprises, sovereign wealth funds, and, in rare instances, direct loans to other countries. Many governments, including the U.S. federal government, have negative net worth. China holds the largest share of global government wealth, primarily in the form of foreign currency reserves and land holdings, and is an unusual case where the government directly provides loans to other nations, albeit with mixed success. While global debt itself might not be the primary concern, the way in which this debt is being utilized, particularly the disproportionate investment in non-productive assets, warrants attention.